Hello, everyone. My name is Miguel, and welcome to your first market update for 2026. I am hoping that everyone had a fantastic holidays, that they spent a lot of time with the family, and that your 2026 has started in a very positive way. I'm very excited for today's webinar. We'll be talking about the stock market, what is happening with the stock market, and what is our expectations, and a couple of things and opportunities that we see ahead that you could take advantage of. We'll be together for roughly around 35 to 45 minutes. We'll open up for a little bit of questions, and then we'll have a little bit of fun as well, because there's a lot of things I want to cover with you guys today. But other than that, let's go ahead and get started. There's a lot of content that we have to go ahead and talk about. And again, this is the first webinar of 2026. We had a very positive year last year on the stock markets. And let's see how 2026 behaves. We're expecting a lot of volatility coming our way, a lot of choppiness within the stock market. But for the people that don't know me, I'm one of the senior wealth advisors here at Guerra Wealth. I've been here for the last 5 years, feels like 20 years. Been having a little bit of fun while doing so. We serve here in Guerra over 3,000 families. And yeah, anyways, enough about me. Let's go ahead and talk about Guerra Wealth, what makes us special. So at Guerra Wealth, we park our clients' money at Fidelity Investments, where we manage over $1 billion, and this custodian serves us as the wirehouse to make the decisions with the money. How can we set up many different investment strategies? And not only that, at Guerra Wealth, we don't only talk about investments. That's one of the 5 pillars that we discuss with the clients and the families that we serve. So our process, for the people who don't know and they're new here in the webinar, we put the families that we serve through a 3-phase process. Phase number 1 is the discovery phase, where we get to learn about you, your goals. We will see the areas of opportunity. How can we help you improve the areas that you have right now in your plan that might not be optimized? And then the phase 2 is the execution, where we look at the 5 main pillars of financial planning, such as retirement planning, making sure that a withdrawal strategy is mapped out to make sure that your income from your job is replaced and that you're taking the money out of the different places that are correct according to your financial plan. Not only that, we have to map out your lifestyle, your dreams, and your spending plan. Because I'll give you an example. I just met with a family today in the morning that their lifestyle right now is $10,000 monthly. But we're talking about creating a plan that on the first 10 years of retirement, we might want to bump that up to $13,000 to $15,000 monthly to maximize their retirements, to make sure they're getting the life that they want to, that they're milking their retirements, they're getting the most juice out of it. And those first 10 years, they were telling me, Miguel, we're young, we want to travel. Fantastic. Let's set up the plan in a way that on the first 10 years of retirement, you feel comfortable and you have the peace of mind that you're going to have that stream of income to enjoy the things that you like. And as well, after those 10 years, that the foreseeable future, the next 20 years, hopefully for them, they have enough money as well. That's why retirement plan is a big deal. Now, investment management. How can we make sure that your money is growing more by the amount of risk that you're taking, that the risk reward that you have within your portfolio is efficient, that if you're going to risk a certain dollar amount, you're getting the right juice out of that, the right amount of reward out of your investments. Now, today we'll talk about investments, so I won't really expand on this one real quick. Now, tax planning. Tax planning is a big deal. Today as well, I met with a business owner. We're talking about setting up their business in a specific way that if he was not doing it, he would be overpaying every single year in taxes $25,000. So we had the initial conversation of the strategies that we need to implement by setting up this business in the correct way. Now, it's not only about business owners. There's many different things that W-2 employees could do with their financial plan to save money in taxes. So we need to have those conversations. And the last two, they kind of correlate with each other, which is asset protection, making sure your wealth is not wiped out by lawsuits, medical expenses, and those type of scenarios. And lastly, estate planning. How can we make sure that, God forbid, you're no longer here, your money goes to the right people, that your money does not go to probates, and you have the right stipulations within your trust and contingencies to make sure what you want to happen with your money actually takes place. Now, phase 3, everything's taken care of, and then we have the team working for you. Now, let's talk a little bit about the agenda for today. We'll talk about market performance. We'll talk about what's going on in the market, what happened last year, what has happened over the last couple weeks, what's going on with inflation, key indicators, and what's happening in the economy. And lastly, we'll talk as well a little bit about opportunity and risk, what's going on with the market, everything that's happening right now, how does that correlate with the different sectors of the stock market, and what opportunities we see ahead, and also risks. Now, let's go ahead and get started with this. So where are we right now? So the market over the last year is up 18.55%. Over the last year, when I mean over the last year, I mean from January 14 of 2025 to January 14 of 2026. So the market has done pretty good over the last year, 18.55%. So depending on your plan and your age and the time horizon that you might have with your goals, you might want to see your portfolio at least performing 18.55%. For some different families, that might be taking too much risk. So you have to sit down and do a risk analysis to see what is the right amount of risk that you should be taking within your portfolio. But now, 2025, I know that we spoke on the last webinar, middle of December, but the year ended fantastic. The total return of the S&P 500 for 2025 was 17.9%. Putting aside all the bumpiness that we saw in the market, going back to April, tariffs, then November as well with the government shutdown, the market did very good. There was a lot of shocks that came towards the market, and the market still was resilient. We saw an amazing year worth of performance. And now we've been spoiled, guys. Over the last 3 years, we've seen the market having double digits return, which is fantastic. But here's the sad part. I have met with many different families, and they haven't taken advantage of this rally. Their buckets, their financial buckets and their investment strategies were not really aligned, and they missed out on massive opportunities within their money. I'll give you a scenario. I met with a guy the other day, this gentleman. He had over $1.2 million sitting in cash. You might think, Miguel, did he have CDs, money market, high yield savings? Nope, none of those. He had it on a simple checking account, making nothing. And if you see, right now on the sidelines, there's over $7.7 trillion sitting in cash. This is the highest it's ever been since 2022. There's a lot of money sitting on the side right now. And my hope is with the families that we serve, that your money is optimized. By not taking risks, there's all the things that you could do with your money that your money could be working for you. You could do CDs, money market, high yield savings. There's safe accounts. There's high yield portfolios and low risk portfolios that have optimal performance for your scenario. Just make sure your money is growing. And this hurts me a little bit, guys, because most of the families that we serve and we work with, they work very hard for the money. So our job here is to make sure that your money is optimized, that you're getting the right amount of reward for the risk that you're taking. But you might say, Miguel, they have it in the bank. They're taking no risk behind this money, so there's no reward. Well, you can get some reward by not taking risk. It's just having the right conversation and the right vehicle to your specific situation. And now with interest rates going down, all these different solutions that people have seen over the last couple of years is being affected. Interest rates going down means CDs, money markets, high yield savings. The interest that they're paying you, the yield that they're paying you has been going down over the last couple of years. And the expectations for this, we'll talk about that as well. So if interest rates are going down, you need to be sitting down with whoever's helping you with your money to make sure that you have a strategy in place that as rates go down, your money is still working hard for you. And I cannot stress that enough because there's over $7.7 trillion in cash right now, and a lot of that money is doing nothing. The banks are using on your behalf, and you're not getting any type of reward behind it. And now, over the last year, something that added here, diversification worked once again. The market, there was many different sectors that had amazing performance. There were some sectors that did not do as good as the others. And then there was one sector, one asset class in specific, such as emerging markets and international markets that had a fantastic year. Over the last 5 years, those two sectors right there didn't do so good. That's why you have to be on top of your portfolio, guys. You should not have your money just sitting around doing nothing. You have to be intentional with the way you invest in your money. What is the purpose of this money? What buckets do you have right now? If the goal of one bucket is to seek appreciation and growth in your money, you have to make sure that's happening. By just having it in one specific account, that might not be the goal. An account is not a strategy. You have to make sure there's something inside of that account, a strategy in place to take advantage of this. Now, let's talk about this. What are the expectations for 2026? So we did an analysis and looking at the major institutions, the expectation in Wall Street right now, let's say, the price target for the S&P 500 for 2026 is 7,500, which is about a 9.5% growth in the stock market if everything goes well. But here's the flip side. if you see expectations and price targets, lots of the time, no one hits it. No one's very close to it. And a lot of the time, these institutions that put goals and expectations and the opposite happens. I don't want the folks that we serve to get caught on the wrong side of the coin. So you have to be very intentional with the money. But now for this year, if everything goes well, we're expecting roughly around 12% earnings growth on the economy. When I say the economy, I mean on the S&P 500, on the largest 500 companies in the United States. So if the market does go up this year, let's call it 9.5%, what are you doing to make sure that your portfolio is optimized to take advantage of those opportunities? What are you doing with your money? Are you really aligned with the strategies right now in place? Are you taking the right amount of risk according to your goals? You might be taking too much risk. So if you took too much risk, it might be a good time to rebalance your portfolio, lock in some gains if it makes sense for you, thinking about taxes as well, and shift into different environments that you're still seeking appreciation, but not putting too much money at risk. That if the market flips, because it's midterm election year, you don't get caught on the wrong side and your portfolio drops 20% and you get wiped out of the gains of last year. So you have to be intentional with this, guys. You have to be having the conversations with your advisors. And that's why with the families that we serve, we like to see them at least twice a year, ideally quarterly, to make sure that the strategy they have in place right now matches with their goals. Now, something that I want to talk about, market sentiment and risk. So as you see on this visual, these are all the different sectors of the S&P 500. The S&P 500 does not consist of one specific sector. So people think about that, Miguel, I want to put all the money on the NASDAQ, on the QQQ. Well, the NASDAQ is only one sector that consists of 100 companies of specifically talking about technology. When you look at the S&P 500, what's inside of it is communications, information, industrials, materials, financials, and you guys could see this so on. The way that we do the management for our clients, we're intentional. There's many different things that are happening in the economy. Fiscal policy, what is the government doing right now? What policies are they putting in place? What does that mean for the different sectors of the stock market? Fundamentally speaking as well, what are the earnings of these companies as well? And monetary policy, what is the Federal Reserve doing right now with interest rates and what are their expectations, which we'll talk about that in a second. And what does that mean for each of the single sectors that you see on the screen? Well, now, over the last year, the S&P 500 right now started on a strong note, but if you look at the S&P 500 over the last year, the best performing sector is communication and technology. So AI has been pushing the market. All this artificial intelligence has been driving the market to all-time highs. When you look at companies such as NVIDIA, Google, Microsoft, and so on, they've been having amazing earnings. They're putting a lot of money and they're investing a lot of money into artificial intelligence. But we want to see profits. We want to see all the money that you're investing into all this new innovation. What does that mean in profits? But a lot of people tell me, Miguel, may dot-com bubble happen again? And as I showed you guys on the December webinar, we are not there yet when it comes down to the dot-com bubble. When you look at price to earnings, we're not there yet. The companies right now that are driving all this innovation, they have solid earnings. They actually have profits. Back in the day, a lot of these institutions didn't have actually profits. Anything will go public, an IPO will go public, and these new institutions will skyrocket, and there was not really profits to back that up. That's why the dot-com bubble happened. Stocks will go up very fast, and there was not correlation with the stocks appreciating and the earnings of the stocks. Now, there's all the many different sectors right now that are taking advantage of all this new innovation with artificial intelligence, such as industrials, materials, as you see here with the last year. They've been doing fantastic. Financial sector as well, when it comes down to fiscal policy, there's a lot of, with this administration, they want to push a lot of deregulation that could benefit as well the financial sector. Utilities. There's a big bet right now happening in the economy when it goes down to utilities. The infrastructure right now for utilities is not strong enough to take advantage of all the artificial intelligence to sustain the electricity that's needed for artificial intelligence. Now, that's over the last year, guys. And remember, what we do here in Guerra is called sector rotating and active management. It goes back to being intentional with the money and taking advantage of opportunities as they come around. Now, if you look at over the last year, you have to take advantage of opportunities. I'm not telling you to put all your money into artificial intelligence whatsoever. There's different things that you could put in place within your investment strategy that get benefited by all this boom that's happening on tech. Now, it depends. It depends on your goals, your time horizon. You have to have a mapped out investment strategy to take advantage of all these different opportunities. And when it comes down to our clients' money last year, our portfolios had a fantastic year. The clients that we served, they took advantage of this rally and more, beating the S&P 500, and we're very happy with that. So for the families that we can serve and you might be watching, you might want to sit down with us and do a risk analysis on how is your investment portfolio structure right now to make sure you're getting the right amount of risk. The right amount of reward by the risk that you're taking right now. So that's when it comes down to sentiment right now and sectors. So I want to talk about recessions. So what is the market pricing in right now? What are the probabilities right now when it comes down to recession for 2026? Based on the stock market right now and poly market, which is it takes a bet of what is the expectations on recessions for 2026, there is a 30% chance that a recession might happen on 2026. The average, just so you guys know, the long-term average of recession probabilities is 15%. This is above the average right now. But now, if you think about it, back on April with tariffs, the expectations for a recession were as high as 50%. So the expectations have gone down as the reports have been coming out showing us what's actually happening in the economy, what's happening with GDP, what's happening with inflation, what's happening with the job market right now. So right now, again, there's a 30% chance that a recession might happen in 2026. And we're optimistic with the stock market, but we are very confident with the strategies we have for our clients. So if a recession does happen, because no one has a crystal ball, you have to be intentional with your investments. You have to have the right investment strategy and structure in your investment plan and financial picture to make sure you're able to navigate towards this turbulence in the market. Now, talking about recessions, when you look at the stock market itself, over the last 98 years, the stock market is positive 73% of the time. So if you think about it, we are preparing all these things that people do for the investments. They're preparing for the 27% of the time that the market goes down. So you might say, Miguel, but why can I just put into the market if you're telling me over 50% of the time the market goes up? It depends on your time horizon and the needs that you might have behind this money. There's something called sequence of returns risk, which is one of the major risks a retiree might face throughout retirements, which means if you retire and the market drops, like at 2008, the market drops 40%, your $1 million became $600,000, and you might need $60,000 to maintain the quality of life that you have right now, $5,000 monthly. If you think about it, you go from withdrawing from the $1 million 6% to now withdrawing the $60,000 out of the $600,000. Now you're withdrawing 10%, meaning your money is going to run out faster. You have to be very intentional with the way you're investing your money to battle risk of sequence of returns, which is a big deal. Not many people talk about this. Now, we've been spoiled, guys. Since 2023, we've seen the market doing double digits return. If you didn't take advantage of this, that hurts me. We need to make sure that your money is working hard for you because we've been very spoiled over the last 3 years. So you want to make sure you're taking advantage of everything that's going on right now. But now, if the market does go down, if there's a recession this year, something happens, let's call it with international law or geopolitical speaking, that creates different opportunities and the financial plans according to your goals. Someone that's 40 and the market goes down, that might create a buying opportunity. But someone that's 65 to 70, that's taking income out of their portfolio and a recession happens, that's not really much of an opportunity. That's a risk in that sense. But depending how your plan is structured, there might also be opportunities if the market does go down that you could take advantage of and make more money, in other words. So that's why a withdrawal strategy, once you are retired, cannot just depend on one single account. You need to have many different buckets in place that if the market goes down, you take money from a different place. If the market goes up, you might take money from that specific place or from another one. You have to see what investments to sell, how to take the $5,000 monthly to maintain the quality of life that you're accustomed to. So everything that we're talking about today is investments, But when it comes down to having a financial plan, you have to be intentional, not just depend on one specific account. Guys, I'm looking here at the chat if you guys might have any questions. So I do see here one right now. I'll address that one now in a second because I have a slide just specifically for that one. But here's everything that has happened with the stock market, with the S&P 500 since 1989. I know I showed this one on the last webinar on December, but it's such a great visual. It's such a great visual. Because if you see this, the dot-com bubble, 9/11, right here. Let me put this right here. Yep. Look at 9/11. Look at the housing bubble. Look at the China when the market went down over there. Ebola. I make fun of my clients with this. Guys, do you guys remember Ebola? My mom was freaking out with Ebola came out. That was such a while ago. And look at the minimum impact that it had in the stock markets. Look at COVID, how small it looks. And it had such a massive impact on the economy. When you zoom out and see the market and everything has happened over the last 5 years, it's such a it's the news, they scream a lot of fear. The families that we serve with the plans that we set up for them, a lot of them with tariffs, they didn't even call us because they understood how the money was invested and they understood the opportunities that they were taking advantage of. And if you see here, tariff tantrum number one, back in 2018, 2019. Tariff tantrum number two, back last year. Look at Ukraine, Gaza, and Israel last year. There's always something going on in the market, guys. And the reason why I share this with you, timing the market, which means just guessing when to get in and get out of the market, is one of the hardest things to do. The major institutions, the biggest hedge funds in the country, less than 30% of them are profitable when they do things like that. That's why time in the market, which means staying invested and making sure when you stay invested, you're taking the right amount of risk for your financial plan and portfolio, beats time in the markets. And I think I shared this story once. There's a family that I met with about it's been a year and a half by now, 2 years. They've been trying to time the market going back to 2017, calling a 60% drop on the market. If you see the market since 2017, the market is up. Yes, has it been ups and downs? Absolutely. But this person hasn't really timed the market correctly. He hasn't found the right opportunity to put the money in the market. So buying into the market is easy. Selling is the hard part. You have to know when to sell and how to sell and what to sell, which means taking the money out of the portfolios to your goals or monthly income. But yeah, this visual, I love this visual. There's always something going on in the world. And you have to make sure you understand how is your money positioned and what's happening. What does that mean for your financial plan? Now, right now, since 1950s, what is happening right now in the economy? Where are we in the market cycle? Since 1950, if you look at the stock market from November 1st to April 30th, the market, on average, it returns 8.7%. And from May 1st to October 31st, the market does 3.7%, which is usually the worst 6 months on the stock market. Right now, we are in the best time in the stock market when you look at the months and the cycles. But now, we are in midterm election year. In midterm election year, the market tends to go down because the market doesn't like the unknown. What's going to happen with fiscal policy? A Democrat's going to win, a Republican's going to win. What are the fiscal policies? What will happen with the market? How will that affect different sectors? So midterm election year tends to be a very volatile year. And that's why this year we're seeing a lot of choppiness in the ocean. We just have to make sure your portfolio is structured correctly to navigate the choppiness within the ocean. But now, again, we're in one of the best times or the best time of the stock market when you look at the time period that we're on right now. And let's talk a little bit about what's happening with inflation and interest rates. So when you look at the market right now, what are the expectations for interest rates and what does that mean for the stock market? So right now, the expectation is that the Fed, it's saying they're only going to cut interest rates once this year. Well, now, the chairman of the Federal Reserve, Jerome Powell, will be replaced this year. We have to see who gets elected and what is the outlook of the new chairman when it comes down to monetary policy. Would they be lowering interest rates faster? Would they be more aggressive? or will they not lower interest rates at all and keep it at one rate cuts? So the chances of interest rates going down at the ending of January, they're not likely. There's over an 80% chance that interest rates will not go down at the ending of January when the Federal Reserve they have their meeting to make decisions with monetary policies. Now, may something change? Absolutely. There's a long time from right now, from January 14 to the ending of the month. Something could happen and they might have to lower interest rates. But based on what is the market pricing right now, they're not lowering interest rates at the ending of January. But if they lower interest rates, what does that mean for the stock market? Well, and housing market. Interest rates going down, it means that people could afford a higher mortgage. People could buy more houses. They could get a bigger loan because interest rates right now makes the monthly cost of a mortgage higher. So that's why you see in the news a lot of people pushing for rates to go down to stimulate the housing markets. But they have to be careful because what could happen is inflation could go up. If they lower interest rates too fast, inflation could go up and they might have to raise interest rates later on, and then we'll be in trouble because that could cause a recession. That could cause a correction in the stock market. Now, when you think about interest rates going down, consumer spending, usually it goes up because there's more money injected into the economy. And I know I give this analogy every single time. Think about a business owner going to the bank, accessing more capital at a cheaper cost. They could get a bigger loan. They could access capital. Hopefully, they reinvest it back into the business. They create more jobs. By creating more jobs, they could hire Miguel. Miguel gets a job. He has income. He could go down the street and spend more money. So, in other words, there's more money in the money supply, but you have to be careful. If they lower rates too fast, there might be too much money in the money supply, like it happened back in 2022, where inflation went as high as 9% and they had to raise interest rates. So we have to be careful with this. Now, what are potential risks that we might see? We have to look at the job markets. We have to see what's going on with the job market right now and unemployment. And do we have a resilient job market or do we not? What's happening with unemployment? So with the Fed, they do have a tough job right now making those decisions over the next couple of months. And then with this change with the chairman of the Federal Reserve, we have to be very cautious with that because that could stimulate the markets or that could cause a pullback with the market, depending on who gets appointed and what is the outlook when it comes down to interest rates. Now, what are some, and I get this question a lot on a daily basis, Miguel, with everything that's happening in the world right now, and you look at Venezuela, you look at Ukraine, you look at Greenland right now, what does that mean for the markets? So with the oil control right now that's happening in Venezuela, that could stimulate the oil markets, that could create more volatility. Well, fiscal policy there is not really solid. It's not a, how can I say it? There's not really a plan mapped out that's public that we could see how can that stimulate the markets, and then the market will price that in. So I'll give you an example. When Venezuela and everything that happened over there, oil companies went up in price. Some of them got affected. So there's a lot of tension that's happening when it comes down to that. So you have to be careful with the sectors and how your money is positioned. If you have lots of money in energy right now, you can get benefited or you could get affected. You have to make sure you have the right amount of money, a percentage of your portfolio exposed to those different sectors with everything that's going on when it comes down to energy and oil. Now, when you look at China and Taiwan right now, yes, that could definitely affect tech. When you look at the semiconductor, the chips, and how that could affect the S&P 500, because there's over a 30% weights on the S&P 500 with this exposure that's happening over there. Now, Russia and Ukraine, same conversation. What's going on with tariffs? What does that mean to that side of the world? And what's going on with energy? And then as well, tariffs could make inflation go up. So we have to see that. We have to be cautious with that. And what does that mean with fiscal policy? So with the market being at all-time highs right now, the market is very sensitive to all these policies and everything that's happening all around the world. So I'll give you a scenario. With the administration we have right now, about a couple of days ago, they announced that the interest rates on credit cards will be capped off at 10%. If you look at companies like American Express and these different companies that get benefited by interest rates and credit cards, lots of them, and Visa as well, they went down drastically over 5%. That definitely affected them. That's why fiscal policy right now, you have to be very careful with it. And what does that mean to your portfolio? How exposed are you to these different things? Now, I want to talk to you about opportunity and risk. When you look at like I was sharing with you guys right now, interest rates, again, we have to be cautious with interest rates. We have to be on the lookout. And then everything that's happening right now, all this rotation within the sectors, that creates opportunity. You have to be careful on how is your money positioned today. If you don't know how your money is positioned today, because you might have a 401k, you might have an account with the government, a TSP, you might have an account with the county or a hospital, 403b, a 401a, and you might want to review that. We could sit down, we could do a risk analysis to see how exposed are you to all these different conflicts and all these policies that are happening right now. And are you actually taking advantage of that? Or are you actually on the wrong side and being exposed to the downside of it? So that's something that we could do. Now, going back to it this year, what are we expecting? Again, lots of volatility in the stock market. 2026, we are expecting a very volatile year. So you have to make sure that your money has the right investment allocation, meaning how much money do you have invested into the safe buckets, not exposed to all this choppiness within the stock market, and how much of your money do you actually have invested into the stock market seeking appreciation within your portfolio in the risky buckets, and how much money do you have on the cash bucket for needs, projects, wants, luxuries that you might have, and how are you taking advantage of the higher interest rates that we have right now, because they're expected to go down. So having the right investment mix plays a massive deal when it comes down to the investment strategy and the withdrawal strategy that you might have throughout retirements. Now, questions. I'm looking here at the chat right now, guys. I'm sorry I haven't looked at the chat that good over this webinar, but I see a couple of our clients saying hi. Yep. Now, I see a lot of clients. Actually, I see one question about silver. Miguel, what do you think about silver? When it comes down to precious metals have skyrocketed over the last couple of years. You look at gold, silver, you have to be intentional as well. Be careful with copper, aluminum. What does that mean for your portfolio? How exposed are you to these different things? Do you feel comfortable buying so high right now, gold, silver, or do you want to just expose a little bit into those different sectors? Now, do we believe on it? Absolutely, we believe on it. For the families that feel comfortable, we have different positions for them, but you have to be careful how much you have exposed because it's very volatile. As you might seen, we've seen swings from gold from 3,900 to 4,400 in a matter of days. So you could be very exposed to it. Silver is very volatile, but it could be an opportunity you could take advantage of. And what does that mean for your financial plan and your investment strategy? That's definitely a topic, a conversation you should be having your financial advisor. Very good question. And taxes. Well, taxes is a big deal right now. When it comes down to tax planning, we're in January. We're having conversations with the families we serve already in January for tax planning for 2026. I had many conversations with the clients that I served back in December, making sure that in 2026, we have the right investment strategy and tax plan strategy to make sure we lower the bottom line of how much money we are sending to Uncle Sam. But yes, you have to be careful with tax planning because right now with the market being on all-time highs, you might want to look at tax loss harvesting as an opportunity for your portfolio and take advantage of different things when it comes down to that. Very good question as well. Oh, I see a very good question. Now, when it comes down to estate plan and investment strategies, asset location is a massive deal. What is the investments that you have within each of the accounts when it comes down to tax classification? So when it comes down to your trust, there's tax-deferred money, after-tax money, and tax-free money. So there's different investments that you might want to have across the different tax classifications because it gives you benefits in terms of taxes. And as well, God forbid you pass away, when it goes inside of your trust, your heirs will get the different benefits as well. I'll give you an example. The risky bucket, you might want to have your Roth IRA, if it makes sense for you, in the risky bucket seeking appreciation. So you get lots of that appreciation on the tax-free buckets. Absolutely. When it comes down to dividend paying portfolios or high income paying portfolios, you have to be careful. That might trigger taxes. So you have to be intentional with that as well. what is the dividend that your portfolio might be generating. I'll give you an example. I met with this lady that she had an account at, I believe it was at Chase or Wells Fargo or Bank of America. They had a high yield paying portfolio in the wrong buckets. She was generating in dividends that she did not need over $80,000 to $90,000, jumping her to the 22% tax brackets for no reason. So she could have had that same portfolio in a different type of account that she did have. So they chose the wrong asset location for the investments that they had. You see how everything correlates with each other? That's why when it comes down to financial planning, you cannot just talk about investments. Everything speaks to each other. The structure within your financial plan, everything correlates with retirements, investment management, tax planning, asset protection, and estate planning. Everything plays a role together. Now, guys, it's already almost 6:40. I don't want to have you here to 8 p.m. on January, and we just started in the year. So for the families that don't know us and they might want to sit down with us and they might want to start phase one, which is the discovery phase, to see how may we see some value that we could add to your situation. Do you guys, at the end of the webinar, there's going to be a QR link that on the first session, what can you expect? You're going to have a meeting. On the first meeting, we're going to learn a lot about you. We're going to ask you a lot of questions, just like when you go to the doctor and do a physical. We're not going to carry you, but we are going to talk about your goals and how do you have everything structured right now. And then we're going to have another meeting so we could see the results of the analysis that we'll do for your taxes, for your estate planning, investments, and the different retirement planning strategies we could implement. And then at that point, hey, Miguel, makes sense, fantastic, let's get started. Then phase two will take place, then where we will have different sessions to discuss each of the areas for retirement, investments, tax planning, asset protection, and estate planning. But so I do see another question here. What can we expect if interest rates go down? So historically, when interest rates go down, the markets tends to go up. Different sectors within the market tend to go up. And as well, when interest rates go down, the housing market as well might get benefited or affected by it. So interest rates going down, that would inject more money into the money supply. That will help as well with jobs as well. But they have to be careful how fast the lower interest rates. Because think about it. As I mentioned earlier, I'm repeating it here for this one client. When interest rates go down, they're injecting more money into the money supply, meaning business owners could go to the bank, get a bigger loan, and hire more people. And historically, when rates go down, there's specific sectors in the economy that get benefited by this. So you might want to make sure that your portfolio is structured in a way that if rates do go down, your money goes, you get the right amount of juice by the risk that you're taking. So that's why we're here. But very good question. So I see another question here. If we have capital gains because of the market, is there a strategy that we could implement? Absolutely. There's different strategies you could implement. There's something called indexing that you could do. And there's different strategies that you could do, tax loss harvesting. But I'll tell you this, over the last 3 years with families that we serve, we've been spoiled. We made a lot of money for the families we serve. So tax loss harvesting might not be something we could implement for them. But indexing, which you could talk with your financial advisor about, might be something that could make sense for your specific situation. And I know this client is specific. I know this couple. But yes, that's definitely something you could talk to your financial advisor to see if indexing makes sense specifically for your financial picture. Now, everything has pros and cons. The best investment vehicle does not exist. You want to make sure that the investment strategy that you have correlates with the goals that you might have. Because many different investments, it's pulling different ways. You want to make sure that your investments are pulling towards your goals. Very good question as well. And it's good to hear from you, Felipe. But well, guys, this is something that, as I was sharing earlier with the Freedom Plan process for the families we serve, what can they expect in the second meeting? This visual right here is fantastic because we're going to grade how you're doing everything right now. We're going to see the structure of how you're doing everything right now and the outcome of doing nothing. And then as well, you're going to see how we could help you implement different things to optimize the way that you're doing things right now within your financial plan. And then at that point, hey, Miguel, fantastic. It makes sense to work with you guys. Awesome. We'll get ahead started with the implementation phase, with the execution over the next couple months. But this is something very good. I don't see many firms doing this, and this is fantastic, where you could see a grade and the areas of opportunity and the cost of doing nothing. And then as well, you could see how we could help. But guys, again, we're wrapping up because I don't want to be here too late as well. I have to go home to my wife. Remember, I got married last year. There's this one saying that I love, and I steal it from everyone. Happy wife, happy life, I think it goes. So I have to go home to her. But what makes us special, guys, we have a big team. We have over 65 employees that helps us serve the clients and the families that we work with. Now, I'm just one of the senior wealth advisors. I am blessed to be in this position talking to you guys tonight and bombarding you with information about the stock market. But what sets us aside is a process that we have and the team that we have. You're not depending only on Miguel. Miguel, yes, I'm a financial planner, I'm a financial advisor, but I have a team that helps me serve the families that I work with. That's what makes us special. And this specific process is fantastic because we can map out each of the areas and see how we could implement different things for each of those areas. Now, guys, there's a QR code. If you might want to scan it, if you're one of our clients and you need a financial review, you could scan this and book the meeting. And I'll see you guys on February. And any questions for the families that we serve, that you're our clients, please reply. We'll book a financial review. If you're one of the new families that we don't serve and you might want to have a conversation and see how we might be of help, scan the QR code, we'll book a session, and then we'll go from there, guys. It's always good talking to the camera. I'm not the biggest fan talking to the camera. I do this for the clients that we serve. And again, guys, good talking to you. I'll see you in the February webinar and have a nice ending